Hi, I'm Emma Hadley, an analytics consultant at the Financial Risk Group, and this is my colleague, Emily Kerrigan, also an analytics consultant.
Hi.
In the past decade, we've seen changes in technology, volumes of data being created, and growth in modeling techniques. What do all of these changes mean for how we model risk?
All the changes you described have forced changes in the way we not only build processes for things like data cleaning, credit risk modeling, and stress testing, but it also changes how we do the work. For instance, we can use AI pairing in everything from the development of data cleaning code all the way to generating reports. And given the pace of all these changes, it's important to make sure that our models don't become stale.
And that's why today's webinar is going to focus on model monitoring. So we'll talk about model drift, which gets at why we need model monitoring. We'll talk about some of the common tests used and what's needed for the process. Throughout, we'll provide common examples of the concepts we discuss, some of which are using a model we built for private equity cash flow forecasting. Let's start with the basics. Emily, what is model monitoring?
Model monitoring is one of the phases of the model lifecycle. It occurs after the model has been validated and deployed into a production environment. The purpose of model monitoring is simple. It aims to reduce model risk by periodically assessing whether the model is performing as expected.
And why is model monitoring important?
Well, any model spends the longest part of its life cycle in deployment. We don't want to just create models, then set them loose and forget about them. Model monitoring is the process by which we confirm that the model is doing what it was set up to do.
What's the process of model monitoring like?
First, you need to choose the metrics you want to use. Then you calibrate your thresholds for those metrics, which is going to be driven in part by your risk appetite. Finally, you execute the model and collect those metrics over time and use the results to inform next steps.
I want to return to the question of why we need model monitoring. Why can't you just develop a model and let it run?
It's said that the only true constant in the world is change, right? Circumstances change, data change, and if we don't monitor how our model is holding up in the face of these changes, we have no way of knowing whether the model is predicting what we think it's predicting.
This brings us to the concept of model drift. Why is this concept important?
Model drift is when model performance deteriorates with time. So there's both a literal and figurative cost of models not performing as we expect. And model monitoring helps us understand where and how the breakdown occurs, therefore minimizes the cost. Essentially, it's a model risk management technique.
How does model drift happen?
Model drift can happen for a couple of reasons. So here I want to introduce two more terms, data drift and concept drift. Data drift occurs when the data generation process the model was built on changes. This type of drift can be viewed as independent variable changes.
And what are some examples of data drift?
One example of data drift might be when the distribution of values within a data element changes due to updates in underwriting standards. For instance, if a bank decides to no longer accept applicants with credit scores below 600. Another example could be when product owners are able to provide data at a more granular level, like using a new source that factors in climate impacts to determine the market value of collateral.
So then, is data drift when data relationships change? Like stronger underwriting rules could mean having a cosigner occurs less frequently. And because it's less prevalent in the data, it's no longer as useful as a credit risk determinant.
It's more that when the distributions of individual data elements change, the model developed based on older distributions of the data may not perform as well. So changes in the relationship between data elements or variables is concept drift.
Oh, okay. So data drift is when the data itself changes. so the model may no longer fit.
Yeah.
Can you tell us more about concept drift?
Concept drift occurs when the relationship between one or more predictors and the model output changes. An example of this change would be if, for instance, economic stimulus payments temporarily change the relationship between unemployment rates and probability of default.
That sounds like a big change.
Yeah, the stimulus payment example is one of sudden concept drift, where an abrupt and unexpected change occurs. On the other side, you have gradual concept drift when there's a slow decay in model performance over time. Um, an example of this might be if changes in the amount an individual can borrow changed how likely folks were to refinance large loans, which impacted their prepayment propensity.
So, to summarize what you've been sharing with us, model monitoring is important because data can change and relationships between data elements can change.
Yeah, exactly.
Okay, let's get into the type of metrics we use in model monitoring. What are the kinds of things we want to look at?
We want to look at the stability of the model with respect to the data, which looks at the elements of model drift that we talked about earlier, and the model's performance, or how accurately it predicts values when compared with production data.
Let's talk about an actual model to help ground these concepts a little more. Here at FRG, we've developed a suite of models to forecast private equity cash flows. We'll call these models our PCF models. One of our PCF models measures the probability of call. Could you use this model to give an example of model stability and model performance?
Absolutely. So, a probability of call model looks at the likelihood that the manager of a private equity fund will request additional capital from investors or make a call for funds at a particular point in the fund's life cycle. So, when we look at model stability in this example, we're actually talking about how similar the model development data are relative to the data in the most recent performance period.
What are some examples of metrics that can be used in assessing stability?
To assess stability, we often use the Population Stability Index, or PSI. This summarizes any shifts in the distribution of model variables. So it compares the distribution of the variable during model development with the distribution of the variable in the evaluation period. And PSI helps us quantify the magnitude of shift because significant shifts can impact model performance. It's also, of course, possible to use more traditional statistical tests like the Kolmogorov-Smirnov test or a chi-square test.
And what about model performance? What's an example of a metric used to assess performance in the probability of call model?
One measure we use is area under the curve, or AUC. This tells us how well the model discriminates between events and non-events. So in the probability of call model, the AUC tells us how good the model is at predicting capital being called from investors versus not being called in a given quarter.
So, what do you do with the metrics?
Well, it's really important to look at more than one metric and to look at data from all metrics over time. Once we have a collection of results from our model monitoring across multiple time points, we can get a picture of the model's performance relative to our expectations. And this is the information we need to make decisions, like whether to make changes to the model or retire it and develop a new model.
So, we've talked about what model monitoring is and some of the metrics we use when assessing a model's performance. What do we need to perform model monitoring?
Well, it might seem obvious, but first you need data, of course. Um, the data includes the predictor variables used in the model as well as the variable being predicted. And they should be realized or actual values, meaning they need to represent what actually happened.
And data doesn't only mean portfolio data, right?
Right. If, for instance, the model uses macroeconomic variables, then you also need to have the most recent value of those variables.
What else is needed?
You need a model execution process that includes the steps necessary to score the models against recent data. There's usually always a platform involved in the internal and external work that we do. This makes model monitoring much more efficient, and it also reduces errors by automating many of the steps.
How often is model monitoring performed?
Well, the frequency of model monitoring should be determined according to the risk of the model and the model usage. In most cases, the model monitoring process is run quarterly, but it can be done more or less frequently if that makes sense for the situation.
And part of actually doing the model monitoring means implementing the tests or metrics we talked about earlier, right?
Right. You need to decide on the metrics you're going to use and set thresholds according to your risk appetite. These thresholds should be theoretically motivated and ideally loaded into the model monitoring platform.
Okay, so let's say you have your data, your process, your metrics, and thresholds. What do you do with the information you get from the model monitoring process?
This is a great question. We talked earlier about how the results from your model monitoring metrics tell you how to move forward, but you don't want to be rushing into changes or making decisions on the fly, right? That's why before you even begin the model monitoring process, it's important to have a remediation plan.
And what goes into this remediation plan?
The remediation plan defines what action should be taken when issues arise with the model.
Things like data quality issues or signs that the model's becoming stale?
Right. So, for instance, a model used for asset liability management or ALM might assume flat or modest interest rate changes. But back in 2022, when rates were hiked, those assumptions were violated. The data changed, so organizations needed to enact some of the items that were laid out in their remediation plans.
What kind of actions are we talking about?
Actions can range in severity based on the significance of the issues. So, a remediation plan might say an overlay is needed if a specific issue arose, like the interest rate assumption violation in the ALM model. For another issue, the decision might be to just do nothing and continue to monitor. And model monitoring doesn't end with getting the most recent performance and making a decision about what to do next, right? Discussion needs to happen amongst model stakeholders, product owners, model developers, etc.
So, once you've completed the model monitoring process, you pull all of this together in a report, right?
Right. So, how formal the report is depends on the model and the stakeholders' needs. A report can contain model information like the model name, ID, version, etc., a description of the model, information about the data source, a description of model metrics, the thresholds used for those metrics, the model monitoring results, of course, and information about the remediation steps to take in the event of issues with the model. Ideally, you'd want this report to be automated so that it can be generated and delivered to recipients after the model monitoring process is executed.
Thanks for taking us through all this info. What are a few takeaways that you'd give to viewers?
First thing I would say is to develop your model execution process. If you already have one in place, review the process and see what parts could be automated. If you don't have one, step one is ranking key models in order of impact to your organization if the model failed. Once you have that ranking, you can start developing at the least a remediation plan for those high severity impact models.
That's a great tip.
Thanks. Another takeaway is that you don't want to be reactionary when seeing the results of model monitoring at individual time points. A lot of money goes into building these models, right? It's important to give them enough time to run so you can evaluate performance over time. A single threshold violation doesn't necessarily warrant a change to or rebuild of the model, right? You've got to look at the context of your model monitoring results. Take the unemployment rate increase during the early days of COVID. You had high rates of unemployment, which should have predicted high rates of default. Those higher rates of default never materialized, in part because of the stimulus payments. Model monitoring results would have thrown up a huge red flag, but that situation was ephemeral.
So sometimes waiting and seeing is a better approach than jumping in and making changes at the first sign of any deviation.
Exactly. My last tip is to make use of model overlays. These are a cost effective alternative to model rebuilds and can help compensate for many model shortcomings. And if you're using a platform, the implementation of model overlays is fairly straightforward.
Well, thanks so much for your time and for sharing this information with us.
You're welcome.
If you're interested in learning more about how a platform can help with model monitoring, you can check out our VOR model reservoir information page. Thanks for watching.